Well, now the inflation has moved from assets to consumer goods, and that is where it's going to stay. It's not going to go back to another bubble. Inflation has now taken hold in the real economy, and this is just the beginning of a long overdue rotation out of financial assets into real goods.
Peter Schiff, an American businessman, investor, author, and financial commentator, is warning us again, this time, to be careful. Schiff strongly believes in being prepared for the worst, and his warnings should not be taken lightly. He has previously warned of a potential economic collapse, and now he is once again warning us of a potential financial crisis. This time, he is urging us to be prepared and to be especially cautious. He believes that the current economic situation is very precarious, and if we are not careful, it could lead to a serious crisis. His warnings are a warning to all of us to pay attention to the current situation and to be prepared for anything that might happen. We must all be vigilant and take steps to protect ourselves, as a financial crisis could have devastating effects on us all. Welcome back to our channel. In this video, we will explore Peter Schiff's view of point regarding inflation and why he warns us to be careful as it would be serious. Please watch, like, and share this video. Also, drop your comments and thoughts below, and remember to subscribe to the channel for more related content similar to this. We begin with a short clip of Peter Schiff.
I think today was a very important day in the markets, and I think there's a good chance that we're going to begin the next leg down in the US dollar, the next leg up in gold, and also experience a bear market rally in the US stock market that could take us through the end of the year. We may end up getting that proverbial Santa Claus rally after all, and it may spark a lot of false optimism for that bull trend to continue in 2023. But I think investors are going to end up being substantially disappointed. The rally that we're likely to have in December, it's not just a Santa Claus rally, it's a sucker's rally, and the Grinch may not steal the bull market before Christmas, but I think he will make his appearance early in the new year, and my expectation is that the U.S. stock market will make new lows in 2023 after we get a year-end rally in 2022, especially in some of the tech stocks that have really been beaten down. There could be a short covering rally as well to finish up the year. Potentially, a lot of the funds that have been short these names may want to cover those positions before the end of the year just to book their profits and have a Merry Christmas and a Happy New Year without wanting to risk giving back a lot of those gains in the waning weeks of the year.
Peter Schiff believes that the United States is headed for tough times in the near future. He believes that the dollar is going to lose its status as the world's reserve currency and that gold will rise in value. He also believes that the stock market will experience a bear market rally at some point. All of these things could have a major impact on the economy and on individual investors. Schiff said that he expects the stock market to see new lows in 2023, especially in some tech stocks. This is because he believes that the current market conditions are unsustainable and that a major market crash is inevitable. Schiff is not alone in his views. Other market analysts have also warned of a potential stock market crash in the near future. According to a recent December post by Forbes, an analyst from J.P. Morgan Chase has also predicted that stock market will get worse in 2023 before it gets better. CNBC also reported that Morgan Stanley's Mike Wilson had predicted a double-digit percentage drop to hit stocks in the first quarter of 2023. All of these have shown that the market is in a bubble that is about to burst and that when it does, it will be worse than the dot-com crash of 2000 or the housing market crash of 2008. Listen to these carefully.
But I think as 2023 begins to play out, it's not going to look like investors expect. Because what I think sparked the rally in stocks today, and of course the rally in gold and the sell-off in the dollar, was the reaction to Jerome Powell's highly anticipated speech earlier this afternoon. And not only did he talk, he also sat down and took some Q&A, not only from the guy who was interviewing him, but he fielded some questions from the audience. I just wish I was in the audience to ask a question, because nobody asked the type of tough questions that I would likely ask. But what I thought was so significant about the speech and the Q&A that followed is the way the market reacted to it, because Powell spoke as hawkishly as I've ever heard him talk. If you listen to that talk and then you listen to the Q&A, Powell admitted that inflation was still much higher than the Fed anticipated, stubbornly high, and that the Fed was committed to doing whatever it takes to bring inflation back down to 2%, and that it's going to take a lot more than the Fed thought. In fact, Powell went on to say that he didn't believe a lot of the private sector forecasts that were predicting a decline in inflation. He just said he didn't believe them. And he acknowledged that prior forecasts had predicted a decline in inflation and that those prior forecasts were wrong. And so he didn't think the current forecasts would fare any better. Powell said that everybody kept expecting things to go back to the way they were, meaning low inflation. The Fed had low inflation for many years. In fact, the Fed thought the problem was not enough inflation, which of course is a good problem to have because it gives the Fed the excuse to create even more. But we don't have that problem anymore, as if that was a problem. Now we have a real problem of too much inflation, and there's nothing that the Fed could really do about it. Powell seems to be perplexed that we're not going back to the good old days where you printed a lot of money, yet consumer prices didn't go up. During those days, you printed a lot of money and stock prices went up. Real estate prices went up. Well, now the inflation has moved from assets to consumer goods, and that is where it's going to stay.
2023 is shaping up to be a tough year for investors, according to Schiff. It's quite apparent now that the stock market is due for a correction and that interest rates are likely to keep on rising. This combination could make it difficult for investors to make money in the stock market. Schiff also addressed the latest interview Jerome Powell, an American attorney and investment banker serving as the 16th chair of the Federal Reserve since 2018, had with some journalists who threw some tough questions and answers to him about the country's economy. Schiff said that Powell admitted that inflation was still much higher than the Fed anticipated, and that the Fed was committed to doing whatever it took to bring it down, but that it was proving to be stubbornly high. This is tantamount to an admission of defeat from the Fed, as it shows that their policies are not working. Listen to these carefully.
It's not going to go back to another bubble. Inflation has now taken hold in the real economy, and this is just the beginning of a long overdue rotation out of financial assets into real goods. It's just that Powell doesn't understand this yet, because I don't think Powell or any of his comrades over at the FOMC really understand inflation and why it was apparently so low for so long, despite all the quantitative easing. They don't get the fact that they got lucky and they pressed their luck with multiple rounds of quantitative easing. And also part of the reason that inflation wasn't a problem was because we lied about it, because we were relying on government manufactured metrics for calculating the effects of inflation, price increases. Those government measures, the official way that we look at consumer prices, as I've been saying, were designed to mask the degree to which inflation was causing prices to go up. And so that lulled the Fed and other central banks who have similar issues into a false sense of complacency that they could keep on creating inflation without that inflation showing up at the supermarket. Instead, it showed up in the stock market where everybody liked it. Well, now it is in the supermarket and pretty much in every market on Main Street. It's not just on Wall Street, and this is going to be a big problem. In fact, I think the problem is already manifesting itself on Main Street this Christmas shopping season. I think the sales that we had on Black Friday and Cyber Monday, while they're talking about record sales, these record sales are not adjusted for inflation. if you do adjust for inflation, it's a decline. But I think the decline is going to get worse as the shopping season unfolds between now and Christmas Eve or whatever it ends. And I think it's going to be a very disappointing shopping season. But I think Main Street's pain could turn into Wall Street's gain, at least between now and the end of the year, as investors start anticipating the pivot.
According to Schiff, inflation has taken hold of the real economy, and it's something we will all have to live with in more years to come. The most immediate impact of inflation will be on those who hold debt, as their payments will become increasingly difficult to meet. This will cause some defaults and foreclosures, which will, in turn, put downward pressure on prices. This will be especially true for housing, which is already in a precarious state. According to projections made by Trading Economics global macro models and analysts, the United States inflation rate will be 7.40% by the end of this year quarter. The United States inflation rate from 1914 to 2022 was 3.29% on average, with record highs of 23.70% in June 1920 and 15.80% in June 1921, according to Trading Economics model. Here is a graph picture that shows the United States inflation rate from January to October. From the pic shown, the inflation rate reached a peak of 9.1% in June, which was really high beyond expectation. This shows that it would be very hard for the Federal Reserve to reduce the inflation level back to 2%, and Powell was right in his statement. Listen to these carefully.
And I think that's what was behind today's rally in the face of Powell's hawkish statements. Because when he kept talking about how stubbornly high inflation was and how the Fed is committed to bringing it back down and how we're going to have to keep on raising rates and that rates are still not high enough to bring inflation down, they need to go higher. But not only do they need to go higher, and probably higher than we thought, but they need to stay there longer than we thought in order to bring inflation down.
Inflation is a natural consequence of economic growth. As the economy expands, the demand for goods and services increases, which inevitably leads to higher prices. This is why it is important for investors to diversify their portfolios and hold a mix of both real and financial assets. In the short term, inflation can be a drag on the economy. It can erode consumers' purchasing power and lead to higher levels of debt. However, in the long term, inflation can be beneficial for the economy by encouraging investment and stimulating economic activity. The key is to keep inflation in check. If it gets out of control, it can lead to destructive economic consequences. But if it is managed properly, it can be a powerful tool for promoting economic growth. That's all for today. Kindly share this video with your family and friends, and don't forget to hit the like button and subscribe to our channel for more updates like this. Thanks for watching. Anticipate our next video update.